Ever wondered how you can navigate the cryptocurrency world without the fear of price volatility? Allow me to introduce you to stablecoins. Stablecoins are digital currencies designed to maintain a stable value, unlike other cryptocurrencies that can see dramatic price changes. They achieve this stability by being pegged to a reserve asset such as a fiat currency like the US dollar, commodities like gold, or even other cryptocurrencies. The purpose of a stablecoin is to be able to use a cryptocurrency without the usual volatility. They allow you to store your crypto funds on the blockchain at a stable price without the need to frequently onboard and offboard funds between a bank account. Traders and investors use stablecoins to safely store value when the crypto market is really volatile and protect themselves against extreme price swings. In the crypto space, stablecoins are commonly referred to as the pause button for crypto holdings. For example, if you don't want all your money in Bitcoin for a period of time, you can effectively swap all or a portion of your Bitcoin for a stablecoin to limit your risk, allowing you to dodge Bitcoin price swings which may ultimately occur, thereby preserving the value of your holdings until you're ready to trade again. Stablecoins also make it easier for traders to transfer funds between crypto exchanges, which is useful since some exchanges do not offer fiat currency deposits or withdrawals. Stablecoins are also much easier to move around than fiat currencies within the crypto platforms. Stablecoins fall within three main categories. Fiat-backed stablecoins are backed or collateralized by fiat currencies at a 1-to-1 ratio. This basically means that one stablecoin is equal to 1 unit of fiat currency. For every unit of stablecoin that exists in circulation, there is 1 unit of real fiat currency being safely held in a bank account or reserve to back it up. Tether and USD Coin are the most popular examples in today's crypto market, both pegged to the US dollar. Crypto-backed stablecoins are backed by cryptocurrencies. These stablecoins are similar to fiat-backed stablecoins in how they maintain their peg with an asset. However, the key difference is that the asset is a cryptocurrency, not a fiat currency. Because crypto can be volatile, these stablecoins are often over-collateralized to ensure stability. An example is DAI, which is pegged to the US dollar but backed by Ethereum and other cryptocurrencies. Then we have algorithmic stablecoins. These are not backed by any fiat currency or cryptocurrency reserves. Instead, they use smart contracts and algorithms to control the supply and stabilize their value. When the crypto market is volatile, the risk is that the algorithm can't react quickly enough, so algorithmic stablecoins are prone to losing their pegs, making it the riskiest out of the three stablecoin types. Overall, stablecoins offer stability in an otherwise volatile crypto market, making them a crucial tool for traders, investors, and anyone looking to use cryptocurrencies for everyday transactions. They mimic the stability of fiat currencies while maintaining the innovation and speed of digital assets, making them an essential tool for anyone engaged with cryptocurrencies. Don't forget to like, share, and subscribe for more content, and be sure to tune in for the next one.